There is a quiet restructuring happening inside one of the most powerful technology companies in the world. Thousands of businesses that built their entire livelihoods around it are now watching their revenue disappear. Microsoft has been systematically cutting its own longtime partners out of some of the most lucrative contracts in enterprise software. We're talking about a commission pool worth $2.5 billion dismantled piece by piece. The companies that earn from those commissions are seeing their businesses hollowed out. It's documented, reported, and already showing up in public earnings reports. So, let's look at what is happening, why Microsoft is doing it, what it means for the businesses caught in the crossfire, and what it might mean for the enterprise customers who relied on those businesses for guidance. Microsoft does not sell all of its software directly to large organizations. For a long time, it relied on a network of specialized companies called licensing, solution providers, or LSPs. These are accredited businesses, some of them large, some of them mid-sized, whose job was to sit between Microsoft and the enterprise customer. They handled the complex licensing negotiations, helped companies figure out which Microsoft products they actually needed, managed the paperwork on multi-year contracts, and renewed those contracts on a 3-year cycle. The contracts at the center of this story are called enterprise agreements, or EAs. These are the long-term software licensing deals that large organizations, think hospitals, banks, universities, government agencies, sign with Microsoft to cover their use of products like Microsoft 365, Windows, Azure, and a whole suite of enterprise tools. These are not small deals. The global enterprise agreement market has been estimated at roughly $200 billion across 3-year cycles. That is enormous. For every one of those contracts that an LSP facilitated, they earned a commission, typically around 1 to 1.5% of the deal's value. That sounds like a small percentage, but on a $4 million contract, you are talking about $40,000 to $60,000. Multiply that across an entire portfolio of clients, and you have a sustainable business model. The global commission pool paid out to LSPs was estimated at $2.5 billion in 2023. These companies did not just push paper, they served as technical and commercial advisors. They understood the nuances of Microsoft's licensing terms better than most internal IT departments could. They negotiated on behalf of their clients, helped them avoid overpaying, flagged when contracts were being renewed on unfavorable terms, and often served as the customer's main point of contact with the Microsoft ecosystem. For many enterprise customers, their LSP was effectively their trusted guide inside a very complicated licensing world. That model worked well for a long time, and then Microsoft decided it no longer needed it. On January 1st, 2023, Microsoft made what it framed as a routine administrative change. It announced that it would begin handling the renewal of certain enterprise agreement accounts directly through its own sales force, rather than routing them through LSP partners. The language was understated. The consequences were not. What Microsoft was doing, in practical terms, was reclaiming ownership of its largest and most valuable enterprise customer relationships. Instead of an LSP managing the renewal conversation, where the LSP earns a commission, Microsoft's own sales team would now handle it directly. No intermediary, no commission. Microsoft keeps the full value of the contract. Within 1 year, by January 2024, Microsoft had already reclaimed roughly 1/3 of all large enterprise agreement renewals from its LSP partners. That is a significant shift in a short period of time, and it was just the beginning. Projections from Microsoft, support specialist US Cloud, one of the more closely watched analysts of the Microsoft partner ecosystem, laid out the trajectory clearly. The global LSP commission pool dropped from $2.5 billion in 2023 to an estimated $1.67 billion in 2024. It is expected to fall further to around $583 million in 2025. And by 2026, the projection is essentially zero, because by that point, all large enterprise agreement accounts are expected to have been transitioned to Microsoft's direct sales model. To be clear about the scale of what this represents for partners, while $2.5 billion sounds significant in absolute terms, it represents less than half a percentage point of Microsoft's EBITDA. For Microsoft, this is a rounding error. But for the LSP businesses that depended on those commissions, the relative impact is estimated to be up to 10 times more severe. We are talking about businesses where EA commission income made up a substantial portion of total revenue. When that revenue disappears, those businesses face an existential choice: transform quickly or begin to shrink. The clearest real-world example of what this restructuring looks like in practice is a UK company called Bytes Technology Group. Bytes is listed on the London Stock Exchange, which means its financial results are public and reported on. And what those results show is stark. Bytes is one of the UK's largest Microsoft resellers. Roughly half of its gross profit has historically come from its Microsoft business. that made it extremely exposed to any changes in how Microsoft structured its partner incentives, and those changes hit hard. In July 2025, Bytes issued a profit warning. The company told investors that it expected gross profit for the first half of its fiscal year, 2026, to come in flat compared to the prior year, and operating profit to be lower. The company directly attributed part of this to the reduction in Microsoft enterprise incentives that had taken effect in January 2025. On the morning that news broke, Bytes' shares fell more than 25%. By the time the half-year results were formally reported in October 2025, operating profit had dropped 7% year over year, despite the company's total invoiced income actually rising. This is the dynamic that makes the Microsoft partner situation so unusual and, frankly, so difficult for the businesses involved. You can be growing your top line, bringing in more business, signing more customers, and still see your profits declining because the margin structure that your business was built on has been quietly taken away from underneath you. An analyst at research firm Megaboit summed up the concern about Bytes bluntly, noting that Microsoft partner change elements are starting to bite and flagging that with more changes potentially incoming, the company remained highly exposed. The question hanging over the business, and over many others like it, is not just whether it can absorb this particular set of changes, it is whether Microsoft will continue restructuring its partner economics in ways that are difficult to predict or plan around. The Microsoft party line on all of this has been relatively consistent. The message is, essentially, enterprise agreements are an older model. The future is the Cloud Solution Provider Program, or CSP, and partners should transition their business toward that newer framework. The CSP program is structured differently. Instead of earning commissions on long-term enterprise contracts, partners under CSP sell Microsoft Cloud services, Microsoft 365, Azure, and related products on a more flexible, often monthly or annual subscription basis. Microsoft has pointed to CSP as the path forward and has even described it as offering higher margins for the right kinds of partners. But here is where it gets complicated. Managed service providers and smaller Microsoft partners, the ones who were supposed to benefit from the CSP program, say that Microsoft has not done enough to protect them within it. UK-based managed service providers have been particularly vocal about this. When Microsoft introduced CSP, it framed it as a way to level the playing field, giving smaller partners a fair route to compete for cloud software sales. But what has happened instead, according to those smaller providers, is that the same large LSPs that dominated the enterprise agreement market have moved into the CSP space and are using their scale to undercut everyone else. These large players are accustomed to operating at margins of 2 or 3%, thin margins that work because of sheer volume. Smaller providers, who are earning margins of around 15% as direct partners and around 7% as indirect partners, find it impossible to compete when those larger players walk in and undercut them aggressively. One managed service provider described the situation this way. The LSPs are walking in and trying to take contracts that should belong to smaller partners, and Microsoft is allowing it to happen despite earlier commitments to protect pricing parity. The result, according to these smaller providers, is that the licensing margin is being destroyed entirely to the point where there is no financial incentive to compete on Microsoft licensing at all. So the picture that emerges is more layered than simply Microsoft taking revenue from partners. It is a restructuring of the entire partner hierarchy. Microsoft takes the large enterprise contracts for itself. Large LSPs move into the CSP space and squeeze out smaller partners. And smaller managed service providers find themselves squeezed from both directions simultaneously. And if all of that were not enough, Microsoft made another significant announcement in August 2025 that compounded the pressure on its partner ecosystem. Microsoft announced the elimination of volume-based discounts for online services, products like Microsoft 365 that were covered by traditional enterprise agreements. Under the previous structure, large organizations could negotiate favorable pricing based on the volume of licenses they were purchasing. Those discounts could be substantial, and they represented one of the key reasons large enterprises valued the EA framework and the partners who helped them navigate it. Starting November 1st, 2025, those volume discounts were gone. Microsoft framed the change as a move toward pricing consistency and transparency, noting that Azure had already moved to a flat rate model. But the practical impact was significant. Some large enterprise customers were estimated to be facing price increases of close to 13% on their Microsoft software costs, which, for a large organization spending tens of millions of dollars on Microsoft licenses annually, could translate into millions of dollars in additional expenditure. One technology company executive told CIO.com that the lack of volume discounts would push his company's annual Microsoft software expenses up by 10 to 15%. For a business managing hundreds of seats, he said, that is a big impact. The elimination of volume discounts also removes one of the remaining levers that LSPs and other partners could pull on behalf of their clients. If there are no volume discounts to negotiate, one of the primary value propositions of using a partner, having someone in your corner to argue for better pricing, becomes much harder to deliver. Why is Microsoft doing this? The honest answer is a combination of factors that are each individually understandable, even if the aggregate effect on partners is damaging. First, there is money. As discussed, the commission pool represents a modest fraction of Microsoft's overall earnings, but recapturing it is still meaningful, particularly for a company that has been under pressure to demonstrate continued revenue growth as it invests heavily in artificial intelligence infrastructure. Second, there is control. Enterprise agreements have historically given customers and their LSP advisors considerable negotiating leverage. Microsoft wants tighter control over its enterprise pricing. Third, there is a genuine strategic shift toward the cloud. Microsoft's future is in cloud subscriptions, in Azure, in Microsoft 365, in AI tools like Copilot. What Microsoft has not fully reckoned with is the disruption this causes to the businesses that were instrumental in building its enterprise customer base in the first place. For the LSPs and resellers caught in this transition, the path forward is clear in theory and difficult in practice. They need to diversify. Commission income from enterprise agreement renewals cannot be the foundation of a business going forward. That revenue is gone. The partners most likely to survive are those that can reposition themselves as service organizations rather than licensing intermediaries. For enterprise customers, the transition creates its own complications. The advisory layer that LSPs provided was genuinely useful. Understanding Microsoft's licensing landscape is not simple, and many IT departments relied heavily on their LSP partners to navigate it. Moving to a direct relationship with Microsoft may mean faster processing of some transactions, but it also means losing an independent advocate who was, at least in principle, working on the customer's behalf rather than Microsoft's. The broader signal this sends to the technology industry is also worth noting. Microsoft's partner ecosystem has long been one of the most extensive in enterprise software. If Microsoft is willing to restructure that ecosystem this aggressively, it raises a legitimate question about how durable any partner arrangement with a major platform vendor ultimately is. The companies that understood early that no platform vendor owes them a living are the ones best positioned to survive this. The ones that did not are learning that lesson now, the hard way. If you found this breakdown useful, subscribe. We cover the business and strategy side of the technology industry,